Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent jobs report. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out Into the Cryptoverse Premium at intothecryptoverse.com. Now, we actually had a lot of job reports come in this week. To just take a quick look, on Wednesday, we had ADP employment. We also had US job openings. I know it's not necessarily directly related, but we also had the ISM manufacturing, which did have some insight into the labor market. On Thursday, we had initial claims and continued claims. And then on Friday, today, we had non-farm payroll, the unemployment rate, hourly wages, and hourly wages year over year. So quite a lot happened over the last few days in terms of the labor market. Now, a lot of people here might not enjoy listening to videos on the labor market, and perhaps they've already tuned out. But I will say that the labor market is important in understanding future monetary policy. Okay? So, if you think back to 2019 and 2020, so I started my channel in 2019 and 2020, I was very bullish on the altcoin market, right? But ever since Q1 of 2022, when we went back to tighter monetary policy, I've been not interested in the altcoin market. And before we really get into the jobs data, I do know there's a lot of people here that are interested in the altcoin market. Who are we kidding? That's basically the only thing people are interested in. But you should note that last cycle, if you go look at the Bitcoin dominance, you like how I snuck it in? If you go look at the Bitcoin dominance last cycle, you can see that it really topped out. I mean, it had a parabolic rally later where it sort of swept this high, but it topped out in September of 2019. Now, a lot of people, I think, were hoping that the dominance would have already topped out, because over here it topped out in September 2019, so you could theoretically equate that to September of 2023. But I think the bigger thing to look at is interest rates, right? And you can see that the dominance did not really top out until after the Fed started cutting rates, right? So this orange line is the Fed funds rate. And you'll see pretty clearly, right? Pretty clearly that dominance did not top until September, whereas the Fed started cutting, 1 to 2 months before that. So altcoins still bled to Bitcoin, right? They still bled to Bitcoin until the Fed went back to looser monetary policy, right? So if you go look at any of my videos in 2019 and 2020 and 2021, I was pretty bullish on the altcoin market, especially even against Bitcoin, But you'll note that I started my channel in the summer of 2019. That wasn't a coincidence. We had gone back to looser monetary policy, and I thought it represented an opportunity to take on a certain risk and just wait to see what happens, right? And the point is to say that even once alts bottom out against Bitcoin, they can still go down on their USD pairs. It's just about, are they worth the risk or not, right? And as long as you're in a period where interest rates are going up and at elevated levels, the expectation, in my opinion, right? In my opinion, and again, this opinion is debated by many, but in my opinion, the dominance of Bitcoin should go up. And while it has been debated almost every single month for the last 2 years, the dominance has just continued to slowly climb as monetary policy has become increasingly restrictive, right? So if you think the labor market doesn't matter, you should understand that the labor market is more or less key to identifying when the Fed will take us back to looser monetary policy. And once we get back to looser monetary policy, then from that point, altcoins collectively might actually bottom out against Bitcoin. Okay, so that is the reason why we follow the labor market. It's not because I have some fascination by, what the, is it 3.8% unemployment or 3.9, right? I mean, at the end of the day, that's just a number, and it's 0.1% doesn't really make a huge difference. But it's important to recognize, because these overarching trends in the labor market will dictate monetary policy, and monetary policy dictates whether your altcoin is going up. So to go through some of the different things from this past week, let's just sort of go in order. We have ADP employment. So we'll start with that. So ADP is the Automatic Data Processing Research Institute. We had another data point come out. You can see that 113,000 jobs were added, according to the ADP, to this survey. All right. Now, that doesn't necessarily mean anything in and of itself, but if we look at a month-over-month percentage change and zoom in to basically, let's say, starting from January 2021 through today, the month-over-month percentage change has been slowly going down. In fact, we are at levels, the last couple of months, the ADP has been printing pretty low levels, lower than we've seen, right, for a long time. Oftentimes, what I like to do, well, let's first go look at the year-over-year change, right? So when you look at a year-over-year change, year-over-year percentage change, you can see that it topped out pretty high at like 6%, but it's been dropping, and by March 2023, it hit 2.42%. It went up slightly in the summer, and ever since the stock market really started to roll over back in the summer, which was a correction that we said was a likely correction that was going to happen, this year-over-year percentage change has been dropping, right? So now it's down to 2.13%. Now, unfortunately, we don't have data on here going back to prior recessions other than the financial crisis, or other than the pandemic, and that one, of course, dropped a lot quicker than likely anything we would see this business cycle, right? Normally, it's a much slower bleed that ends up in recession, okay? But that is where it currently is today. Is it around 2% year-over-year percentage change? So it is still going up, right? It is still going up. You could look at a quarter-over-quarter percentage change and see that it's starting to get pretty low, right? It's starting to get pretty low, but it is still technically going up. And in a recession, you would probably start to expect negative prints, right? You would expect negative prints. We're still not seeing that, right? So again, while it's true that the economy is slowing down, it's not necessarily true that these numbers are printing recessionary territory just yet, right? And again, it doesn't mean if you're thinking about how this relates to markets, remember, markets often bottom, in a recession or around the time that a recession is declared, and that's because they're forward-looking. So, if you're waiting for a recession to be declared to sort of figure out which way the market's going to go, the market probably already went there, right? Because as soon as you know about it through the headlines, market priced it in long ago. So the ADP is still technically up year over year. Month over month percentage changes are getting pretty low though. So, as long as that happens, right, the future year over year comps, right, they're going to start to look even worse because the rate is starting to drop. So unless it picks up, then that year over year percentage change is likely going to keep dropping. Okay. Now this is total private. We can break it down into other sectors, right? We could go look at manufacturing. I think that's an important sector to look at. It only added 3,000 jobs according to this survey, right? This does not really look that great. I mean, it looks like it topped out in February of 2023 and it dropped and then now it's sort of leveling out. But a year over year percentage change of this sector certainly looks like it's getting into some recessionary territory. Now, you could argue that so did 2016. And yes, this is why I've said many times that 2015, 2016, we had a recession scare. There were worries in the market back then that the U.S. was heading into a recession. But the U.S. avoided a recession. But you can look at these charts and figure out why people were worried. And I mean, there were pretty big drop-offs in the S&P 500 going into that, okay? So this is getting into some pretty negative territory here year over year. And unless this picks back up, it's probably going to continue to get worse. Okay, this is the manufacturing sector. And we could look at other sectors as well. There's financial activities, which have seen a move to the upside recently, right? So I want to try to show you different sectors. Some are looking better than others. Financial activities is up about 21,000, whereas manufacturing is down. Professional and business services is down 10,000. So that's really starting to show some weakness here. Looking at a year-over-year percentage change, you can see that it's recently gone negative, okay? Which it never even went negative in 2015, 2016. So a lot of things changing, and some sectors look better than others. Leisure and hospitality, I imagine, is up. It is by 17,000, but you could argue that it's potentially starting to top, right? I mean, the growth is slowing. Look at a month-over-month percentage change, right? The growth is really starting to slow here, and you know, if this continues, right, if 5.5% for the Fed funds rate, if that's sufficiently restrictive to slow the economy down, then this will likely continue to get worse, right? So that's the ADP, right? That's the ADP. And that came in at 8:15 a.m. on Wednesday. We also have job openings. So job openings is useful because there have been a lot of layoffs over the last year, but we haven't really seen it reflected that much yet in the unemployment rate. And one of the reasons for that is because job openings, while they have come down considerably over the last year, just look at a year-over-year percentage change, right? Negative. It's been negative for a while. This is jobs. Let's look at a percentage change, right? It's been printing negative really since August of 2022. It hasn't gone positive ever since then, right? But it was coming from a pretty high level. There was a lot of excess in the economy. And so if you think about drawing an imaginary line through here, you can see that this correction by job openings has more or less just gotten us back to trend, gotten us back to prior trend, right? So we actually added 56,000 job openings. Really, we lost job openings, I believe, compared to last time, but the reason it's showing it as positive is because they revised the prior number. So the prior number, as it stood, I believe we're down from that, but because they revised it, we're technically up. So now we can say we added jobs this month, just like we said it last month, but note that the last month was revised to the downside. So this is total non-farm, but we can also break this down as well. I like to look at the manufacturing sector to see kind of what's going on there, and you can see that it's popped up a little bit over the last couple of months. Now the question is this a new trend, or is it just something like what we saw over here in October of 2022, right? In October of 2022, we saw this thing pop up into November, and then it just rolled over, right? So is it doing the same thing where it's sort of popping up here starting in July, and will it eventually just roll over, sort of going below the prior trend? So right now, you can still argue that it's still holding the prior trend, therefore it's not recessionary territory just yet. If we go below the prior trend, then I think you argue that we're in recession territory. You could look at total government. I imagine jobs were added there. They were not, it looks like. So job openings, government actually lost 81,000. So that's interesting. But again, government jobs have been part of the reason why job openings have remained relatively elevated for as long as they have, just because of how many jobs have been added just over the last several months. We could take a look at durable goods. That's one that I typically check in on. It's popped up a little bit here recently, so we'll want to see if this continues or not. And we can look at maybe one or two others. Professional and business services dropped a little bit this last month. And maybe one last one, we will look at leisure and hospitality. Pretty big move up, right? Added 181,000 job openings, okay? So all in all, job openings had a pretty good month, right? I mean, at this point, I think if it's going sideways, that's classified as pretty good, considering that the overall trend has been mostly just lower highs and lower lows, right? I mean, look at this, like just a high, a low, a lower high, a lower low, right? A lower high, lower low, lower high, lower low, etc. So does this just end up being a lower high? Stay tuned to find out. Okay, so that gets you through two of the reports, more or less. We did get the ISM manufacturing data, And there was at least a little bit of weakness in some of the labor components. So do note that, but I'm not going to spend any more time on it because I spoke about it in the other video when we talked about the FOMC. So the Fed did have the FOMC on Wednesday, and they kept rates at 5.5%, which is interesting considering that CPI, core CPI, is still over 4%. GDP came in last quarter annualized at 4.9. Those two numbers alone would make you think the Fed would hike, but Powell doesn't want to, and I don't blame him. I mean, when you look at some of the stuff going on in the ISM manufacturing, there are certainly parts of the economy that are slowing down, right? So if they think that 5.5% is sufficiently restrictive, then they don't, they think that all they have to do is hold it higher for longer, right? Not go up and up forever, just get to a high level and hold it there for a longer period of time. And they're putting a lot of faith that that will bring inflation down. And it's possible they're right. It all depends on whether 5.5% is sufficiently restrictive or not, right? It all depends on that. And unfortunately, I don't know the answer. I mean, I said over a year ago, I thought the terminal rate would be 5.5%, but the question of is it sufficiently restrictive remains to be seen. There is certainly evidence that it is, but the economy has been resilient for a long time, and so we'll have to see how it continues to play out. Now, on Thursday, we had initial claims and continued claims. So we do want to at least talk a little bit about that. So initial claims are still printing at pretty low levels, okay? They're pretty low levels. Now, they have been going up, though. You can see that it's a low was found in October, mid-October, and it's been moving up ever since. The question is this just a lower high, right? Or does it reverse the trend? I tend to think that it likely will reverse the trend and start going back up. But one of the reasons for that is because I think there is evidence that that the labor market is starting to show weakness. If you look at continued claims, that weakness is starting to become apparent. We mentioned a few months ago that last year continued claims bottomed out in September before exploding to the upside until April. It looks like they've bottomed here in September as well, and they're starting to move up relatively quickly. But instead of moving up starting from 1.29 million, it started at 1.66 million. So the labor market has gotten weaker, right? This is starting to move up again. And if you were to look at a year-over-year percentage change, normally when it's positive like this, you run the risk of going into a recession, right? And that's certainly something that we have to be mindful of, is that this is in positive territory. And it's just a matter of how long does it stay there. If it stays there long enough, then yes, I think it ushers in a recession. But when you look at continued claims, you'll notice that it's going up a lot quicker than initial claims. Remember though, initial claims are sort of showing you, new layoff, like new people that have just been recently laid off and they're filing an initial claim. Continued claims tell you something different. They tell you how hard is it for people that have been laid off in the past to find a new job. So for a long time, people that were getting laid off were not having as much of a hard time finding a new job. But now, even though initial claims have stayed relatively constant for several months, continued claims are going higher. So those people that are getting laid off are having a harder time finding a new job, right? They're having a harder time finding a new job, and that's reflected in the continued claims. And the reason why that's important is if you go look at the unemployment rate versus claims, and we isolate continued claims and the unemployment rate, you can see that the continued claims tends to lead the unemployment rate, right? If continued claims is starting to move higher, the unemployment rate typically follows, okay? So that's something that I think we have to take into consideration, is that continued claims are starting to move up. Therefore, that is showing some weakness in the ability for the market to absorb these people that are getting laid off, right? Earlier in the year, people who got laid off tend to have not a hard time finding a new job on average, right? I don't mean to say that everyone had that. Now it seems like people are having a little bit of a harder time. And the reason for that, of course, is as more and more people get laid off, those other companies that were looking to hire, perhaps they don't need to hire anymore because they already hired the other people that were laid off, right? So as the business cycle continues to unfold, the continued claims likely continue to go higher. Now, at this point, continued claims are going up, even though initial claims are relatively flat. But what happens if initial claims in a few months start printing in the 250K or the 300K level? Right now, they're still just off 200K per week. But what happens if they start printing in, say, the 300K level? If that happens, then and the economy is having a hard time absorbing new people to the labor force, right? If there's not as many people hiring, if job openings are going down, then that can really lead to continued claims going up quickly. Because not only are people not hiring, but more people are getting laid off. And then that gets reflected very quickly in the unemployment rate. You can see that it takes a long time for the unemployment rate to move, right? We'll just sort of sit at low levels for a long time. But then when it moves, it can move quickly, right? I mean, like look at the financial crisis. I mean, we basically just hung around that 3.8 to 4% level for over a year. And then once it started to move, it went 4.3, 4.5, 4.6, 4.9, 5, 5.3, 5.7. I mean, it moved so quickly once things started to break, right? And you can see that in other business cycles, it's no different. Here's the dot-com crash, same thing, right? Once it moved relatively quickly. I think I was actually looking at the dot-com crash initially. Yeah, I was when I said the financial crisis, I meant the dot-com crash. The financial crisis actually went up even quicker. You can see it started off in the low 4s and then topped out at almost 10% unemployment. So this is why we follow it. It's because continued claims leads the unemployment rate. And if initial claims start to go up in any material way, that's where it could really start to affect continued claims, because more people are getting laid off and they're having a harder time finding a new job. Therefore, the unemployment rate goes up. So that covers initial claims and continued claims. And then today, we got non-farm payrolls, the unemployment rate, hourly wages, etc. So if you go look at non-farm, total non-farm, this is through the report that we got today. This is different from the ADP. You'll see that we added 150,000 jobs. 180,000 were expected, but that's really neither here nor there. I mean, it's just a 30,000 difference. But the point is, it still hasn't printed negative, right? Normally in a recession, you would expect it to really start to print negative and start to drop, right? It hasn't done that yet, okay? And until it does that, I mean, I think you can find a reason that it's not a recession, right? As long as there's more jobs opening up. Again, it doesn't mean that the unemployment rate isn't going higher. It is. But until this starts printing negative, you're going to have reasons to say that it's not a recession, right? I mean, this is why it takes so long for them to declare a recession, because by the time it's obvious in the data, the market already priced it in long ago. I mean, if you go look at prior recessions, here's sort of 73, right? I mean, like the market was dropping well before total non-farm dropped. And in fact, by the time total non-farm dropped, the market bottom was in, right? So then they declare a recession retroactively. Everyone says, oh crap, it's a recession, so they sell. But then that ends up being the bottom once the recession headline actually arrives. Same thing over here, right? The market was dropping. By the time it started printing negative territory, that was near where the market bottom was. So when you look at it today and we see it going higher, once it starts to print negative, assuming that it does, I mean, eventually it will, right? I mean, depends on if it's, is it in 2024? Who knows, right? But when it prints negative, that can often correspond near to a cycle bottom, okay? Now, looking at it on a month-over-month percentage change, you can see that it's slowing down, right? So back in February 2022, 0.6% change. In July, 0.37, so about 0.4. So 0.6 in February 22. By the summer, it was at 0.4% month over month. By January 2023, it was at 0.3% month over month. By September, it was at 0.2% month over month, right? So what do you notice? The labor market is starting to show signs of weakness. And Powell knows this, right? I mean, it doesn't, you don't have to be like a genius to figure out like why Powell is not hiking another 25 basis points. is because he can see the data, and the data suggests the labor market is slowing down. I know they took recession out of their forecast, but what's interesting about that is that, by the time when they took recession out of their forecast, that was basically what marked this top. Go back and look. When the Fed, they took the recession out of their forecast right here, and that's when the market dropped. Does it sound crazy that GDP is at 4.9% last quarter? It was at 4. It was funny enough, Q3 of 2007 GDP annualized was at 4.9% in Q3 of 2007. The reason, of course, we already went the reasons of the FOMC stuff. So just go watch that video if you want me to talk about why I think that happened. But it's interesting. It seems like things are playing out how they always have. It's just taking a long time, which is how it always has, right? It always takes a long time. In the pandemic, it all happened like that. Everyone thinks it's going to happen like that again, or a lot of people do, and it just doesn't. It takes a long time for this stuff to slow down. So there's a lot of noise in this chart for total non-farm. I like to smooth it out using like a 3-month moving average, and you can kind of see a clearer picture here, right? It's slowly trending down. Now, the issue is if it goes negative, that could mark a bottom for the S&P, right? Look at all these prior periods where it actually went negative. That marked some lows on the S&P. Here, it did not mark the low. In the dot-com crash, it did not mark the low. The recession lasted a lot longer. In the financial crisis, it did not mark the low. During this period over here of the 70s, during high inflation, it often marked the low. So I'm telling you now, if we get into a recession in, say, 2024 or something, and the market's dropping, once these numbers start to print negative, that might be the bottom. I know some people think the bottom's already in, and they could be right? I'm just saying, if it plays out into a recession, recessions are notorious for putting in a lower low. That's total non-farm, okay? We can break it down into categories. Let's go look at manufacturing. I believe that it dropped. It did. Almost negative 8,000 jobs. Sorry, that's a moving average. Negative 35,000 jobs, right? In the manufacturing sector. Starting to go down. Look at a year-over-year percentage change. It's almost negative. It's almost negative for manufacturing. Look at total government. It's up 51,000. All right, what else is new? The government has been hiring a lot. Construction, up 23,000. You can see oftentimes prior recessions corresponded to construction employment level going down. It hasn't gone down yet. It's slowing down potentially, right? If you look at like a quarter over quarter change, or maybe let's look at a month over month percentage change and zoom in, and then maybe average this out over 3 months. It's been slowing, but not very fast, to be completely honest. So that one still doesn't really look that bad yet. So what else do we have? The unemployment rate. The one that rules them all. It all comes down to that, right? It's now at 3.9%. You can see I sort of built out this base down here. Notice that it popped up over here to 3.7 and then spent the next several months going down, and then it popped up again, spent months going down, popped up again, spent months going down, popped up, but rather than go down, it went sideways and then up. There is a shift here. It is happening. It's just happening very slowly, right? But my guess is we start to print in the 4% range within the next few months. It could happen next month. But I'm guessing within the next few months, it starts to print in the 4% range, especially if continued claims continue to go up like they have been. So the unemployment rate is starting to go higher. And you can see that when the unemployment rate goes up, that's where the recession starts. A lot of people think that the recession was in 2022 because of 2 consecutive quarters of negative GDP. But the recessions are more so related to people actually losing jobs, right? In 2022, there were not a lot of job losses. In fact, it seems like everyone had trouble finding people. All these prior recessions corresponded to the unemployment rate going up. Now, it's also true that if you were to look at gross domestic product, right? So that's gross national product. If you were to look at gross domestic product and adjust for inflation and look at a, sort of like a year-over-year percentage change, it's true that when it goes actually, let me look at a quarter over quarter. It's true that usually when it goes negative, it's a recession. But it's also true that usually when it goes negative, it also corresponds to a rise in the unemployment rate, which did not happen in 2022. So that is, again, I always see people saying that the recession was in 2022. I wholeheartedly disagree. I don't think you can have a recession when the unemployment rate is at 50-year lows. Right? How can you look at this chart and say, oh yeah, guys, like this period here, this was the recession, right? This was a recession when the unemployment rate was going down. When every other instance of these recessions were when the unemployment rate was going up. So I think the people that think that 2022 was a recession could be in for a rude awakening if a real recession comes where the unemployment rate goes up. And if the unemployment rate does not go up, then it wasn't a recession, right? It was just a bear market. But I'm still of the opinion that it will likely trend higher because that's what it normally does during these aggressive rate hiking cycles. And this has been the most aggressive rate hiking cycle that we've ever had. So I look at the unemployment rate. It's now at 3.9%, starting to move higher. And it seems like, continued claims is leading the way. So I would guess it's going to continue to go up. There's some other things that we can look at. We can look at this is the unemployment level. So just another chart that you can look at. This is like you can break it down into category. So like this is greater than 16 years. You can break it down to sort of into subcategories. So like this is between 16 to 19-year-olds. That's been moving up a lot. That's starting to look a little scary of a move here. Look at how quickly this has moved off this low, from 586,000 in April to 863,000 in October. Like this is moving in the wrong direction. Let's look at 20 to 24-year-olds. That actually moved down the last couple of months. So these guys are doing okay, at least according to this. Let's look at 25 to 54-year-olds. It moved up a little bit, right? A little bit, right? But it's still trending up. The thing is, if you look at a lot of these cycles, right, they slowly trend up for a while, and then at some point they break up quickly, right? So the market sort of lulls you into a false sense of security, right? It just sort of slowly trends up, not really doing anything. And then all of a sudden it just aggressively goes higher for 6 to 12 months, and it catches everyone off guard because they get so used to the economy being quote unquote resilient that by the time it's not resilient, it's too late, right? It's too late for them to sort of, have prepared for it. Unemployment level by reason for unemployment. This is always an interesting one to look at. Job losers has gone up again. So this is one that also tends to sort of lead the unemployment rate as well. We could look at new entrants to the labor force. This is one that I imagine will continue to have strong contributions, especially if you think about student loan payments starting back up. A lot of people are probably maybe haven't been working, but now the student loans have started back up. They have to go get a job, or perhaps their excess savings is just dried up and they have to go get a job. So this could be a reason, that unemployment goes up a lot, is because there's just a lot of new people entering the workforce, competing with people that are already in it. So this is starting to really move higher. And if you were to look at a year-over-year percentage change, right? It kind of already looks like it's getting into some recession-type territory. Let's look at a 7-month moving average. Look at it like that and see where the recessions occurred and look where we are now. So that certainly doesn't seem that great. If you were to look at permanent job losers, slowly trending up, not really a whole lot to see. Job leavers, sorry, let me reload this, see if it fixes it. Job leavers, sorry, is job losers, relatively flat. But that shows you some of this, this data that we've recently got today, right? And then we can go look at alternative unemployment rate measures. Here's one. This is the U1. So U3 is the standard unemployment rate. This is what you're used to. There's also the U1 for greater than 15 weeks unemployed. That one has really popped off the lows recently, right? That one really has popped off the lows. But it's basically been at 1.4% since August. So I would watch that one to see what that one does in the coming months. We can go look at people not in the labor force. It's relatively flat. We can look at a year-over-year percentage change. And just sort of look at what it's doing. No clear indication of how of sort of a trend here. But employment statistics, the labor force participation rate has been moving up. The civilian labor force level continuing to move up. Looking at a year-over-year percentage change of that, you can see that during recessions it does tend to drop off. It hasn't really dropped off yet. Total temporary help services employees. That is probably one of the scarier looking charts because normally the temporary help services, when it goes down, it tends to indicate recession, right? And it's been going down since March of 2022. And if you look at a year-over-year percentage change, right, it's pretty clearly a negative territory, just like it was in the financial crisis and just like it was in the dot-com crash and just like it was over here in the recession in the early 90s. So that's a more scary looking chart. And then we can, of course, look at job quits. I'm not really sure why this is happening. I'll have to get this checked out. But if we look at job quits, you can see that one has been trending down, which makes sense. As it becomes harder and harder to find a job, there's going to be fewer people that quit their job because they're going to be scared that they're not going to be able to find a new job. When times are good, you might not worry about finding a new job, so you quit your job if you don't like it because you know you can go find a new one. As monetary policy becomes more restrictive and we shift from an employee's market to an employer's market, then people are less likely to leave their job because they might be worried they won't be able to find a new one. And you can see that ever since really late 2021, early 2022, this has been trending down, right? So fewer people are leaving their job. This is total non-farm. Fewer people are leaving their job. You can look at a year-over-year percentage change, see it's negative, just like it has been in the prior recessions. Here is the job quits rate trending down. We already talked about initial claims and continued claims. So that's more or less your jobs report, right? Some sectors still seem like they're holding up. Other sectors seem like they're falling apart. Continued claims are going higher, indicating it's harder for people to find a new job once they're laid off, even though initial claims are still relatively low. If initial claims were to go up into the 250 to 300 level, it might lead to the continued claims going up a lot quicker, which would then in turn be reflected in the unemployment rate. So we must understand the labor market so that we can understand when the Fed will shift to looser monetary policy. And by the way, the market, after all the data that's coming this week, instead of expecting a rate cut by June, now they're expecting it by May. Right? Now by May. Again, why is that important if you're a degen at heart and really want to know when alts? Right? Why is that important? Because history shows us that it's not until we get rate cuts that Bitcoin dominance tops out. Look at last cycle. Rate cuts occurred. After we got rate cuts, that's when dominance topped out. That's when alts collectively were done bleeding to Bitcoin. People keep jumping on altcoins thinking they're going to outperform Bitcoin over the macro scale when monetary policy becomes increasingly restrictive. And you might say, well, they've held it flat. It doesn't matter. It's still becoming increasingly restrictive the longer they hold it there. So I know a lot of people were hoping that dominance would have already topped out by this past September because, September 2019, September 2023. But the reason it topped out over here arguably was not just because it was Q3 of the pre-halving year, but because we were going back to looser monetary policy, right? Looser monetary policy, alts bottomed out against Bitcoin. We are not yet going back to and by the way, dominance did not even top when they started cutting. It took a couple extra months after they started cutting for dominance to even top out. Normally, the market doesn't bottom on the first rate cut, right? So when you look at the chart, I look at this chart and I say, well, Bitcoin dominance is likely going to keep going up because monetary policy hasn't changed yet. And until monetary policy changes, alts are likely going to bleed back to Bitcoin, and the Bitcoin dominance will continue to go higher. The market isn't even expecting cuts until mid 2024, coincidentally around the Bitcoin halving, which is normally when altcoins start to outperform Bitcoin in the halving year. It all lines up kind of perfectly to some degree. So the reason we focus on the labor market is because that should give us insight into when we go back to looser monetary policy. And when we go back to looser monetary policy, that's when the Bitcoin dominance is likely entering into a topping process. So we understand the labor market. We study the labor market to understand future monetary policy. Future monetary policy tells us when cryptocurrencies, altcoins, are worth the risk, right? Until then, Bitcoin will likely outperform the altcoin market, whether it goes up or down, because altcoins are bleeding back to Bitcoin regardless. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up. We have these charts, of course, at intothecryptoverse.com. Links in the description below. I'll see you guys next time. Bye.